Hi everyone, welcome. Today we're going to value and analyze a company named Amazon. For those who are watching this video, I don't think there are many who have not heard of Amazon or did not transact with them through their website. So I would not dive deep into their business model, how they make money and so on. I would just add a quote to the extent that it's an e-commerce platform. You could buy a lot of product through their website, Amazon.com, and it will be delivered to your address. Another segment that make money is AWS, which is a competitive product with Azure or Google Cloud. And another sector that they make money from is through grocery store. That segment compete with Walmart, Target, and Kroger, etc. There are a lot of good videos on YouTube by a lot of content creator that they look at the Amazon from a qualitative point of view in terms of what's their business model is, how they make money, what's their competitive advantage, what's their moats, etc. I leave those videos into the description of this video that I found useful and educational from my point of view. For disclaimer, I have no affiliation with them. If you would like to pause this video, go and watch a few of those videos in the description. You're more than welcome to, or if not, by all means, please keep watching this video. In this specific session, I'm going to value Amazon from a quantitative point of view and assess what's the fair value for the equity in the company. When I value companies, I would like the management to be owners of the business. So I take the look at the 14DF form and look at what's the ownership of the business through management, board of director, and so on. Regarding Amazon, 12.7% of the company is held by insider holdings, and those insiders, which is 16 individuals, Jeff Bezos accounts for majority of it, almost 99% of that 12.7. So in a nutshell, he is keeping his eye on the store. If you've heard recently, is not the CEO anymore. Andrew Jassy is the current CEO of Amazon, but Jeff Bezos remains on the board and overview the management and keep them disciplined. One thing about the 14DF that I've noticed and I've heard from the other people in the industry that they have a long vesting period. They reward management and employees not with salary necessarily, but more with the stock options and restricted units. And they have high vesting periods, so they would create incentives for them to stick around and make decisions for increasing the value of the business in the long run. It has its pros and cons, but from a shareholder point of view, being an owner, this is a pro sign. We're going to look at the financials first, how it has done over the years, and where Amazon stands as of today. I have about 15 or 19 companies in my sample where I think they're really similar to Amazon, like eBay, Shopify, BigCommerce, and so on. So I compute the beta of these companies, the weekly return of their stock versus S&P 500 for the past 300 weeks, and evaluate the unlevered beta of my sample. So with that, the unlevered beta that I arrived for Amazon is about 1 as of now. And you see this number pre-pandemic was about 1.07. Now it's back to 1.1. It's really a small fluctuation, but that's the unlevered beta that I assess for the business. As far as long-term ratio and current ratio, which is total asset divided by total liabilities for the long term, and in the short term would be current asset divided by current liabilities. I intentionally subtract if they have any goodwill on the balance sheet from the assets. It's a plug variable, so it's not really assets. So it's a really true current ratio, if you would say. For Amazon, recently it dropped to below 1. The long term is still above 1. As a matter of fact, it's about 1.38. I have no concern if Amazon's going to have any problem in the short term within the next 12 months meeting their financial obligation, paying vendors, employees, and so on and so on. So To me, it seems sounds. The current debt to equity ratio of Amazon is about 10%, which tells me they're really not levered that much. The risk-free rate as of September 2nd of 2022 was at 3.2%, roughly 3.1%. And the AAA in the bond market was 4.4, and BAA's was 5.4%. These are the metrics I look at. What should be the cost of debt for Amazon, for in terms of valuing the company from a firm point of view. Um, I also take a look at the interest that they paid over the debt that they owned, based looking at the balance sheet and the income statement, and that's about 1.8. This is pretty interesting, pretty amazing. They secured a debt at a very low cost of debt, if you would say. So that's a good for being a shareholder, from shareholder point of view. This chart represent the total debt, total cash, and interest coverage ratio. For currently is about 7.5 for the interest coverage ratio. The total debt is about 124 billion. Total cash about 160 billion. A solid interest coverage ratio in terms of company meeting the interest payments in the future. One metrics from Warren Buffett point of view when he analyzed companies is SG&A ratio. He would like to see the SG&A, sales, general, administrative, and marketing. Those expenses adds up. If you cumulative altogether, if you divide it by gross profit, you don't want it to be more than 30%. Amazon has been considered retaining that number below 30. Just recently, it's gone shoot up significantly higher. I'm confident that the management will be able to get it back under control. This one is the operating leverage. This one explains the, the rate of change in revenue for the past 12 months for each quarter, and the rate of change in the operating income adjusted for R&D for the past 12 months. And that's going to tell me if the revenue goes up, then the operating income goes up, or if the revenue goes down, the operating income goes down. But giving me a sense of magnitude of them. This is perhaps the most important chart that we're going to take a look at. It's driven from the income statement. The red bar represents the revenue for the past 12 months, trailing 12 months. The blue line represent gross profit margin at quarter level. The red line represent gross profit margin for the past trailing 12 months. And that's why, so you see it's smoothed out relative to the blue line. The gross profit margin for Amazon, this number currently is about 16%, but historically has been higher, about 20%. But it has to do something with inflation, with excessive cost in the supply chain and so on. I feel confident that this number will bounce back up a little bit more towards its historic norm. The operating income margin, I compute in two ways. Once I compute it based on whatever you see on the income statement, which is this purple and the green. The green is for quarter number. The purple color is for trailing 12 months. The orange and the light blue are the operating margin for quarterly and trailing 12 months. However, I adjust this number for R&D. The way I do it is I capitalize R&D for the past 3 years for Amazon. From my point of view, R&D is expense that takes place today and will provide benefit over the X many years into the future. And for Amazon, that X many years is equal to 3 years, in my opinion. So what I would do, I capitalize this expense, I adjust the earnings, and I depreciate the R&D for the past 3 years that were invested into other projects, basically. So after doing all those math and going through that process, the operating income for Amazon comes to be somewhere around 10% for the trailing 12 for the current quarter, and for the trailing 12 months comes about 8.8%. This chart summarizes the operating income margin adjusted for R&D for all of the companies that are listed here, Salesforce, eBay, Etsy, FedEx, and so on. I would like to get a sense, okay, how the operating margin looks like across the other businesses that's Amazon operating, because they are a logistic company, they are some sort of advertising company, they are sort of a search engine. I just want to get a sense of what the operating margin looks like across these businesses that Amazon is. A logistics company is about 10%. Operating income for Amazon at maturity could be about somewhere between 10% to 40%. It depends how much revenue is driven through AWS versus the logistics portion of the business. The sales to capital ratio is the revenue that Amazon generates for every dollar that they invest into the business. I compute that for all other companies in my sample, and again, these numbers are adjusted for R&D. I do the same for return on invested capital across these companies again to get a sense if Amazon, return on invested capital is high, is low relative to its peers. This is the chart that summarizes the return on invested capital for Amazon specifically over time. The red bar represents the invested capital for Amazon, which is total liabilities and stockholder equity minus cash minus goodwill minus long-term investment. The green one is book value on the balance sheet plus the equity value on the balance sheet. The green one is more common way to compute the invested capital. I do it both ways, and if these two numbers are drastically different, I try to investigate why and figure out, okay, what would be the real return on invested capital for the company. Regarding Amazon, return on invested capital adjusted could be around 14.9% through almost 9.6 or 10%. So I think the correct number is somewhere around 12%, 11%, if I take the median or the average between these two numbers. And that is consistent throughout the time, and it means Amazon is earning more return relative to the cost of capital. And that's what you really want to see when you're investing in companies. You want them to earn higher return compared to cost of capital. It means the management reinvest well. The firm reinvestment coming from cash flow statement. So it seems like the company has been investing heavily since post COVID, and that goes to their logistics business. As I was doing some research where they've been investing recently. This one is a sales to capital ratio that we talked in the chart above, but this is specific for Amazon throughout time. And as you see, as they've been, getting more capital intensive, the sales to capital ratio has been decreasing. They're bringing less revenue relative to the amount that they invest into the business. Again, these numbers are adjusted for R&D relative to the book value of debt and equity invested. Computing both ways, the number is somewhere between 1 to 164. I tend to think this number is around 140, somewhere between these two numbers. The free cash flow, again, from cash flow statement, they've been negative in the recent years because of reinvestment. I'm not too concerned about that. These are some scatter plot that shows me, okay, if as revenue has been growing, gross profit has also been growing or not. And if so, with the color scale, I kind of try to navigate whether the gross profit has been coming down or has been increasing, and what was happening. This is for the operating income adjusted for R&D. This is not adjusted for R&D, and this is the net income. This is the correlation matrix between the variable that are in my income statement, cash flow, and balance sheet. If you were interested to explore, by all means, go ahead. I have the link of the collab file in the description. What's my story? Well, my story is that e-commerce space will continue to grow, and Amazon will grow with it. AWS keeps the business profitable and funding the other segments, even though other segments are still profitable, but that's the really core where the profits coming from. Amazon investment in logistics will begin to pay off in the next few years, 2 to 4 years. They are currently experimenting in UK, where they are essentially functioning as UPS and FedEx as an alternative over there. you could ship packages through Amazon without necessarily buying stuff from them. So based on the story I said, how am I going to assess the value? Well, the risk free rate is about 3%. The equity risk premium, implied equity risk premium, is about 5.5%. The equity value is about 1,300,000,000,000. Debt value is 124 billion. Current cash on the balance sheet is about 60. The unlevered beta that I choose is 1.1. The terminal unlevered beta is 1, so I reduce the unlevered beta as we move throughout time. I think the beta is going to converge from year one. It means if I'm going to do my evaluation in 10 years, over 10 years, I'm going to reduce from 1.1 to 1, and it's going to start immediately from next year. The current pre-tax cost of it is about 2. The terminal is assessed to be about 4%. The cost of debt begins to converge in year 5. Effective tax rate, based on what I was looking at their income statement, and I see they've been reinvesting a lot, so I keep that number around 4, and I will move it towards the marginal tax rate, and I start doing it from year 6. The revenue base means current revenue is about 486 billion. I will create 3 cycles for revenue. It's going to be a slow growth. It's going to start from 3.2, then starts to increase to 5.5, and this cycle is going to last for 3 years. This is due to economy, slowing down. There's a lot of talk about recession and so on. So I don't give a high growth for the next 3 years. But then from there, 3 years from today, after they go through this cycle, they will grow at 12%, and then slowly the growth will decline to 9% per year, and that cycle gonna last for 5 years. In the 4th year, they're gonna grow at 12%. In the 5th year, perhaps about 11 and a half. In the next year after that, it's gonna be about 11, and so on. The 3rd cycle is the beginning from the end of cycle 2, which means from there, that 9% is going to decline all the way to 2.8, which is the growth rate in perpetuity, and that cycle is going to take about 5 years. So in total, I have 5, 5, and 3. My valuation interval total is about 13 years. The convergence in the growth rate from the beginning to the end is going to begin at the next year immediately. The current sales to capital ratio is about 1.5, and it's going to decline to 1.4. It's going to converge immediately from next year. Current operating margin is about 11%, and based on what we saw on the top regarding Microsoft, BigCommerce, Shopify, Target, all the FedEx, UPS, and all those other companies that we saw, I assessed that number, the mix of the terminal operating margin, to come to be around 16.5%. And it's going to converge in 2 years from today. I also give some credit to the management that they, continue to reinvest well and earn higher than the cost of capital for about 2.5%. And with that, when I run my numbers, the value of operating assets is about 1,165,000,000,000. Adding cash, subtracting debt, the firm value would be about 1,226,000,000,000. The equity value would be about $1,100,000,000,000. That's the story I'm telling. And some checks that I will have, usually I look at the revenue, so I'm growing it from 486 all the way for the terminal year is going to be $1,243,000,000,000. This is a very, 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 very large number. There's no company in the history on the earth that ever earned 1.2 trillion in revenue. But again, this number should be adjusted for inflation because there are 13 years into the future, but it's still it's a lot. It's very big. So that's my valuation. That's my point estimate. But however, I'm uncertain about lots of these variables that we have. We have about 30 variables here. The risk-free rate, the equity risk premium, how long the growth cycle will last, what will be the revenue growth, and so on. So in order to deal with this uncertainty, I build a Monte Carlo simulation with different distribution around these variables to come up with a possible range for equity value in this business. So doing that and building some correlation between these variables, I will arrive at the following histogram. So the lowest valuation I got was about 572 billion, and the highest I got was 1,700,000,000,000. Currently, the current market cap is about 1.3. The median, if I were gonna say if I would be unbiased, to want to pay the fair value, I want to pay a market cap of 1,080,000,000,000. And no surprise, this number is very close to what we got up here, which was 1.1. It's because I build my sensitivity or my Monte Carlo simulation based on my base case. So currently, I find the equity the stock to be about 21% overvalued based on the story I said on the top. But it is possible, the company could be 1.27. So the green through the red one is my comfort zone, but I feel much more comfortable buying it at the yellow line, which is the median 50 percentile and lower. With that said, that is pretty much it. I hope you find the session useful. The link to this Colab file and all those videos that I talked about earlier would be in the description. Feel free to explore them. I also leave the link to my Google Drive where I have the archive of all the companies that I've analyzed. There are usually a Colab file in there. Some of them have some slides where I walk you through, my analysis. Feel free to explore them. I hope you find this session useful, and I see you in the next video. Thanks very much for sticking around.